Several of you have been asking in the comments why the financial system feels like it is moving in two directions at the same time. The Fed cannot cut because inflation could wake right back up, but it also cannot stay too tight because the bond market, the banking system, and refinancing pressure start cracking underneath the surface. And on top of that, digital gold, stablecoins, and parallel payment systems are quietly changing who actually has power in the financial system. Today we are going to separate signal from noise on all of it. This is Go Finance. Let us start with the biggest claim, that the Fed is trapped. At a very basic level, that is fair. Not because the Fed has no tools, not because it is powerless, but because every tool now seems to come with an ugly trade-off. The latest policy decision kept the federal funds target range around 3.5% to 3.75%. The 10-year Treasury yield has been sitting around 4.3%. Consumer inflation, based on the latest official reading, has been running in the mid-2% range, while another major inflation gauge the Fed watches closely appears hotter, closer to the upper 2% area. Gasoline prices moved back toward $4 at the end of March. None of that gives the Fed an easy green light to rush out and cut. And this matters because for years the market got used to a certain kind of medicine. Every time something looked soft, people leaned toward lower rates, more liquidity, more cushioning. So now a lot of people still look at housing or weak demand or stress in some corner of the market and say just lower rates and fix it. Except that does not really fix it. If a house is too expensive, making the loan cheaper does not suddenly make the house cheaper. It can keep the sticker price elevated for longer. Mortgage rates are still above 6%, and home prices are still not exactly cheap. Affordability improved more because the market cooled than because homes became easy to buy. Lower rates are not a magic affordability machine. They can help at the margin. But if years of easy money pushed people into stretching and bidding up everything, then going right back to that same reflex is just pressing rewind on the same problem. And that brings us to the second big claim, that real price discovery needs to come back. Years of low rates changed behavior. They changed what looked normal. They changed what got funded and what did not. They rewarded duration, leverage, and the promise of tomorrow. They punished patience. They made people comfortable paying up for assets because money itself felt cheap. That is not just about stocks or homes. It bleeds into private markets, venture deals, commercial real estate, long bonds, and investor psychology. When money stays cheap for a long time, it does not only raise prices, it bends judgment. But here's where I want to push back on part of the argument. A lot of people jump from that to saying, therefore the only answer is brutally higher real rates until everything resets in one violent move. Markets do not always heal in one dramatic purge. Sometimes they reprice through time. Sometimes inflation cools faster than expected. Sometimes wages catch up a bit. Sometimes weak sectors get squeezed while stronger sectors muddle through. Sometimes the bond market does part of the tightening on its own. There is a third possibility, which is a slower, messier, less cinematic unwinding. Still, even if the adjustment comes slowly, the stress is real. The St. Louis Fed has highlighted a large maturity wall running through the middle of this decade, especially in commercial real estate. That is why higher for longer is not just a slogan. It lands on real borrowers. Long rates staying elevated can keep pressure on balance sheets, even when short rates are no longer screaming higher. That is why the Fed looks boxed in. Now, once you understand that, the inflation picture becomes easier to read. If inflation were falling cleanly, energy were calm, yields were easing, and growth looked weak, the path toward cuts would be more straightforward. But that is not the backdrop right now. Recent energy moves have been noisy and at times sharp. Oil has jumped on renewed Middle East worries. Gasoline moved higher. Market pricing around future Fed easing became less confident. The Fed does not just have an inflation problem, it has a credibility problem if it eases into another energy-led price pulse. That is a different kind of pressure. And notice how quickly the market can flip on this. One day, people say safe havens are unstoppable because geopolitical risk is rising. Then yields jump, the dollar firms, oil rips higher, and suddenly gold and silver get hit anyway because the market starts worrying that inflation means fewer cuts. That is exactly why short-term price action in metals can look so confusing. The same headline can sound bullish at first and bearish a day later, depending on whether fear, yields, or liquidity becomes the main driver. Gold sold off sharply after a big run. Silver fell even harder. And the move was tied less to some clean change in the long-term thesis and more to a rush of higher yields, stronger energy prices, and shifting rate expectations. A pullback is not the same thing as a broken thesis. Sometimes it is just the market changing which variable it cares about first. Does short-term weakness in gold or silver prove the protection trade is over? No. It may simply mean the market is moving from one kind of fear to another kind of fear. If the fear is immediate war escalation, metals can catch a bid. If the fear becomes sticky inflation and fewer cuts, metals can stumble while yields rise. If the fear becomes deep recession and policy panic later on, metals can find their footing again. The path is not straight, but that does not mean the roll disappears. Silver gets especially tricky here. Silver is not just a fear asset. It has 1 foot in the hard asset world and 1 foot in the industrial world. So when macro conditions get mixed, silver can exaggerate the move in both directions. It can look amazing when liquidity, growth hopes, and monetary distrust line up together. And it can look messy when the market cannot decide whether it is pricing inflation, slowdown, or tighter financial conditions. If policymakers cannot comfortably cut and cannot comfortably tighten, what exactly is the market supposed to anchor to? That is not a trick question. That is the reason so many investors keep rotating between bonds, bullion, cash, and risk assets without ever feeling fully settled. Now, let us get into the part of this story that is more interesting than the daily Fed drama. Because underneath the daily market noise, there is a separate shift happening in financial plumbing. And plumbing matters a lot more than most people think. Most investors spend their time watching price. They watch charts, they watch headlines. What they do not always watch is the rail underneath the price. The settlement path, the reserve structure, the custody layer, the way value moves from one side of the system to the other. That quiet layer is where some of the more important changes are starting to show up. Take stablecoins. If more dollar-linked digital tokens are used to move money, hold liquidity, or settle transactions, then whatever backs those tokens starts mattering more to the traditional financial system. The regulatory push in the United States has moved stablecoins much closer to the mainstream. A federal framework for payment stablecoins was created, and most of its big provisions are expected to kick in on the earlier of a rulemaking deadline or the start of next year. Market participants have already been talking about stablecoin issuers as a potentially important source of demand for short-dated treasuries. Some people hear that and immediately say the Fed is losing control. That is probably too extreme. The Fed is still the Fed. It still sets the policy rate. It still shapes liquidity conditions. But could the market structure around short-term government paper become more important over time? Yes. Could steady reserve demand from stablecoin issuers affect the front end of the curve in meaningful ways? Yes, at least at the margin. And that changes the conversation about who absorbs treasury supply and where demand comes from. The more the system digitizes, the more trust moves away from speeches and toward architecture. People start asking different questions. What exactly backs the asset? Who holds it? How often is it disclosed? Can it move across platforms? Can it be redeemed? Can it be used as collateral? Those are not small questions. Those are the whole game. And that takes us directly into digital gold. A lot of people still think of gold in old terms only. Bars, coins, vaults, exchange-traded products, futures contracts. That world still matters. Physical ownership still matters. Trusted custody still matters. None of that goes away. But there's another conversation now. Whether gold can become more usable inside a digital financial system without losing the thing that makes gold gold in the first place. The World Gold Council recently made a very direct move in that direction. It launched a new initiative built around shared infrastructure for digital gold products with a big emphasis on interoperability, common standards, and making digital gold easier to issue and use without forcing every provider to rebuild the whole stack from scratch. Think of it this way. Gold is the cargo. The infrastructure is the highway. If the highway is bad, the cargo may still be valuable, but moving it around is clunky, expensive, and limited. If the highway improves, the cargo does not become more real, but it can become more mobile, more legible, and more useful across more settings. That is the smarter way to view the digital gold push. It is not about replacing physical gold with a buzzword. It is about reducing friction around ownership, transfer, collateral use, and system compatibility. Could this fail? Sure. Could the industry overpromise? Definitely. A tokenized claim is only as good as the legal structure, custody, audit trail, redemption path, and operational discipline behind it. Fancy language does not fix weak plumbing. In fact, sometimes it hides it. Digital gold could become a much bigger part of the future if the infrastructure becomes trustworthy enough, standardized enough, and useful enough to solve real problems instead of just wrapping old gold in new marketing. That is the standard to hold it to. Now, there's another reason the market is paying attention to alternative rails, and that is geopolitics. Whenever a country faces heavy sanctions or reduced access to the traditional dollar system, it has an incentive to experiment. Maybe bilateral settlement arrangements, maybe commodity workarounds, maybe crypto rails, maybe local currency channels. And once those workarounds are built, they do not always disappear just because the original pressure changes. Financial improvisation can become permanent infrastructure. Pressure creates adaptation. Adaptation leaves behind tools. If a government, a company, or a network learns how to move value outside the most obvious channels, those lessons do not get unlearned. They become part of the menu. That matters for Bitcoin. It matters for stablecoins. It matters for commodity settlement. And it matters for gold and silver too. because anything that changes trust in the old system eventually changes how people think about hard assets inside the new one. None of this means the old financial system disappears. The dollar is still the dollar. Treasury markets are still enormous. The Fed is still central. But the edges are shifting, and edges matter because that is often where the next decade starts. The market 5 years from now may not look radically different on the surface, but the hidden machinery could look very different underneath. That is how big changes often happen. Quietly first, then all at once in public awareness. If you strip everything down, the core issue for metals is still trust. Trust in money, trust in policy, trust in the purchasing power of savings, trust in the stability of the bond market, trust in governments managing debt without leaning too hard on inflation. When trust is high, metals can look boring. When trust is slipping, metals start looking a lot more interesting. The Fed cannot be casually dovish into sticky inflation. The market cannot casually tolerate high long rates forever without breaking something. Governments cannot casually keep issuing debt without caring who buys it. Investors cannot casually assume the rules of the last cycle will map perfectly onto the next one. That is why gold remains relevant. That is why silver remains relevant. What we are really watching is a transition from a world shaped by years of distorted money toward a world where price discovery, debt costs, collateral quality, digital rails, and hard assets all have to find a new balance. That balance is not here yet, which is exactly why so many people feel uncomfortable. Old assumptions are failing one by one, but the new framework is not fully visible yet. Large economies are all watching reserve assets, payment sovereignty, collateral quality, commodity security, and the ability to move value in a more fragmented world. Some are leaning into gold, some are leaning into digital rails, some are trying to do both. And the more that happens, the more gold and silver stop looking like relics and start looking like assets being reintroduced into a new system through new infrastructure. Not old asset versus new technology, old asset through new technology. That is a very different idea. Watch the yields, watch inflation, watch energy, watch housing, watch the short end of the treasury market, watch how digital gold infrastructure develops, and watch whether alternative rails keep expanding quietly even when the headlines move on. That combination will tell you more than any single hot narrative ever will. We are stackers here. We understand that the market is pricing some parts of this puzzle and completely ignoring others. The part it is ignoring is usually where the opportunity is. Drop a comment below. Do you think the Fed's inability to cut is ultimately bullish or bearish for gold and silver? I read every comment and I will pin the best analysis. Tell us where you're watching from. If you want this analysis in your inbox every morning before markets open, join the Go Finance newsletter. Every day before the session starts, you get a direct summary of what is moving gold and silver, what the data says, and what to watch. No noise, no headlines. Just the information that matters before anyone else has it. Link is in the description and in the first comment below. Subscribe, turn on notifications, data before price. The Vault Keeper.